Welcome back to Shill Man. Personal pay me $40. Woo! Welcome back to Strongman Personal Finance. In this video, I'm going to do a reaction to the financial statements of Royal Caribbean Cruises Limited. And yes, I was compensated $40 to make this video. And if you want a dedicated video made anonymously on whatever subject you want, I have to approve it, of course, before you pay me, then you send me $40. Look at the pinned comment, give me your money, and get a dedicated video. So let's go ahead and look at the financial statements of Royal Caribbean Cruises, because we all remember the lockdowns, the pandemic everything shut down, cruise lines got annihilated, and a lot of people were saying these stocks would 10x because reasons. So let's see how the pandemic actually affected Royal Caribbean Cruises. So first, we're going to start off with the big picture, and then we're going to drill down to the details of the financial statements, because I was paid $40 to do this, and I'm going to do this. So here's Royal Caribbean Cruises. What does Royal Caribbean Cruises do? They operate a cruise company worldwide. No way, really? The company operates cruises under the Royal Caribbean International, Celebrity Cruises, Azamara, and Silversea Cruise brands, which comprise a range of itineraries that call on approximately 1,000 destinations. It operates 61 ships, and it's been around since 1968. That's a pretty old, durable company now, isn't it? Now, let's go look at the stock price. So we could see ever since this stock was publicly traded, looks like all the way back in 1993, it's had its ups and its downs. And then starting in about 2012, it had a massive, insane run-up. And it was doing pretty good until something happened. What was that thing? That was the pandemic. What happens is a company that has a lot of fixed assets, a lot of expenses, if they can't generate revenue, if they have any kind of fluctuation in revenue, they're going to have pretty significant losses because they have these fixed costs that they have to pay for. And a lot of those fixed costs for a company like this with a lot of fixed assets is going to be recorded through depreciation. When you have a lot of fixed costs and not a lot of revenue, you're going to get absolutely swamped. So what happened is the stock plunged and then it shot back up because of the clown market. Then it plunged again at the end of the clown market, and now it's clawed its way back up to 75.61. The last time it was there was roughly 2015 and, I guess 2016 was the last time it was really there pre-pandemic. So what happened? Well, the first thing I like to do is I go to stockanalysis.com, and I like to look at the historical revenue patterns. Now, we can clearly see why the stock price plunged, and we can clearly see that the company seems to have gotten back on its feet, okay? You see this? Whoa, what happened here? What just happened to my computer? I didn't click anything. Now, you see this blank space? Well, you can't see where I'm pointing, but you see the blank space around 2020, right? That's when all the lockdowns happened. But shockingly enough, when all the demand came back, all the pent-up demand came back, the company's revenue absolutely exploded. Now, on an inflation-adjusted basis, it seems like it's been flat, okay? So I guess you could say real revenue growth probably isn't that great. You have to keep in mind inflation. If you look back at 2013 and you see the revenue there, obviously the revenue's higher today in 2022, but also the value of the dollar has plunged pretty significantly. So while they seem to be getting back to where they were before, we've also been through a pretty vast inflationary period. But overall, they've gotten better. Okay, so revenue is kind of getting back to where it was before. That's a good thing. Gross profit was negative. Okay, it was negative during the pandemic, but now it's starting to claw its way back. So you can see the recovery story. Decent growth, maybe not in inflation-adjusted terms, but their profits were growing pretty significantly. Then they plunged because of the pandemic, and now they're starting to recover. This company's coming back. But there's a problem, which we're going to see in a little bit, okay? Operating income. They are now back to positive operating income. But there are some expenses that this company has now incurred and will incur into the future that aren't even reflected in operating income. And that would be interest expense. Now, the company had interest expense before, obviously. Okay, they had debt, they were paying interest. Their interest expense has gone up pretty significantly since the pandemic, okay? Look at this. The explosion in interest expense. And it's only going to go up. Why? Well, I'm going to hazard a guess that they probably packed on a lot of debt, and now interest rates are higher, okay? So this company, because it was struggling to survive, probably had to take out a bunch of debt in order to stay afloat. And we'll see what happened in the statement of cash flows, okay? But interest expense is up, and that's very concerning because that's going to affect bottom line profitability. So if you're somebody that's like, oh, maybe they can get back to where they were before, with these interest rates, it's going to be hard to return to the glory days of before the pandemic. I'm just going to put that out there. Now, when rates drop and they can eventually refinance their debt, okay, great. But for now, their profitability, even if they get back to where they were before, is probably going to be lower because their interest expense is multiple times higher, okay? But you're not going to see that until after operating income. Interest and taxes are basically the last thing that you have on your financials. And then we have the company, which is most recent quarter, still posted a loss. Now, the loss wasn't as bad as before, okay? Obviously, the losses were way worse during the pandemic, and they're basically right there on profitability again. But you can see how, operating income hasn't really recovered. Gross profit is starting to recover, and revenue's recovering, but their net income is not. That's because of interest. Okay, in my opinion, I think, just my initial impression, the interest expense is much higher. So, like I said, don't be like, oh my God, they're so amazing. Oh my God, they're going to come back to where they were before. I'm not so sure about that. Now, funny enough, they issued some shares during the pandemic. Okay, you can see the amount of shares outstanding has gone up, but it's not an insane amount. It looks like, I guess it looks like about 25% increase in shares since the pandemic, which is understandable. Okay, the question is that going to happen in the future? I don't know. So overall, their gross margin starting to come back, but their operating margin and their profit margin are decreasing. So their operational expenses have increased and their interest expense has massively increased. Now, let's go look at the balance sheet. Okay, when you're looking at the balance sheet, you want to look at the most recent balance sheet. You want to make sure that you're looking at the most recent one. So if you go to this website and you hit annual, you're probably looking at the wrong balance sheet, okay? You want to look at quarterly, all right? So what do we want to look at? Well, the first thing I like to compare is total current assets to total current liabilities. Is this company underwater with current assets and current liabilities? Now, this is very concerning to me, okay? I see a ton of current assets, or not many current assets, liquid assets that can be used to pay short-term debts, and I see a boatload of current liabilities. Now, let's go check the current ratio, which is current assets divided by current liabilities, and let's see how that's been over time. Okay, so it looks like they've always historically operated with a low current ratio. I guess that's just the nature of the business. But to me, I don't like looking at a balance sheet and saying, oh, we have 2.4 billion in, sort of liquid assets. I wouldn't count inventory or other current assets necessarily. We have 2.4 billion of cash equivalents that can be converted to cash within a year. And then we have 9 billion in current liability. So right off the bat, that's like, whoa, that's a lot. Oh, okay. That's a little freaky. Now, it looks like about 2 billion of that is current debt. Okay. So when you think about a company's debt, you have debt that's due within a year and the debt that's due outside of a year. Current debt is debt that's due within a year. Okay, so this 2 billion is going to have to be either paid off by the company or rolled over and refinanced. And what's the problem with that, ladies and gentlemen? That's going to lead to higher interest expense. Okay, so that's going to affect profitability because that current debt that's about to mature in less than a year, that $2 billion was a lot cheaper probably to finance, depending on what type of debt it was. I mean, maybe it's like, long-term lease or something or whatever. But that current debt that's about to expire was probably cheaper to finance on average than it is now. So when they roll that over, they're going to be paying more interest expense. So that's also something to keep in mind. Now, let's look at total assets versus total liability. So we can see they're very asset heavy. They're very PP&E, property, plant, and equipment heavy. They have a total assets of 32 billion, almost 28 billion of which is property, plant, and equipment. So when you're looking at a company like this, a lot of times, let's say they bought a bunch of equipment in the past, but they're not really buying that much now. As an example, you're going to see much lower net income usually than cash flow, because the net income, what's happening is they're expensing the depreciation over their assets' useful lives. They're expensing it on the income statement. So you're going to see huge amounts of depreciation expense. But on the statement of cash flows, it gets added back because depreciation is a non-cash expense. So you're going to see discrepancies, unless there's generally you're going to see discrepancies between operating cash flow, especially, and maybe free cash flow versus net income. But you kind of have to compare them both and kind of see what your company favors more. But this is a very asset-heavy company. So they have 30 billion of long-term assets, and they have 20 billion of long-term liabilities. Overall, I've seen worse, okay? They have equity in their property, plant, and equipment. And one thing you want to keep in mind is that this PP&E, property, plant, and equipment, when you buy something, let's say you spend $30 billion. Let's say a company spends $30 billion on an asset. That asset's value can only go down, and it's either through impairments or depreciation. So you're going to see that value, the 30 billion, go down and down and down and down on the PP&E because it's being depreciated. So if you see new additions, that means they're buying more assets. So the whole point of that is that sometimes assets on the books can be worth more than what you're showing, what you see on the books. That's book value versus fair value. So overall, I would hazard a guess that from a property, plant, and equipment standpoint, they're doing okay. So they're doing great with long-term assets versus long-term liabilities. The long-term seems okay. They're not really underwater. But when it comes to liquid assets versus current liabilities, that's where this company is a little bit more concerning to me. Okay, that is my big concern, is seeing they only have 2.4 billion of current assets and 9.4 billion of current liabilities, debts due within a year. But it seems like they constantly operate that way. So I don't know. Maybe they can keep swinging it, but that's concerning to me. So overall, debt has definitely gone up. Look at the total debt since the pandemic. Gone up pretty significantly. Now, if we look at the common stock account, now we're in the equity section, we can see a massive increase in common stock. What does that mean? That means they issued a bunch of shares because they needed to survive. So it looks like they were issuing a combination of debt and shares to survive, which is fine. But if you were an owner of this company prior to this, you got diluted pretty significantly. And you got to remember, when you buy a company like this, these are the kinds of things you have to worry about. What if there's another outbreak? What if there's another lockdown? You're going to get absolutely wrecked. Okay? So keep that in mind. Retained earnings. So the accumulated profit and loss of this company since inception was annihilated. Okay? It was annihilated by the pandemic. This company made profits in the past, and they stacked up their profits. Now the profits their accumulated total profit and loss is negative. That's pretty crazy, okay? They burned a ton of equity, was destroyed in this business. Basically, they packed on a bunch of debts, and they burned a lot of assets during the pandemic. So we can look at their shareholders' equity. It dropped enormously, okay? Massively. The equity of this company was 12 billion before the pandemic, and now it's down to 3 billion. So this company got absolutely wrecked from an equity standpoint, and it was mostly from losses. And it looks like a big reason they have any equity at all is because they issued shares. If they hadn't issued shares, they would have been wiped out. The equity holders would have been wiped out. They would have been underwater. So that's the only thing that saved them. It's pretty crazy to me. All right, so let's look at cash flow. So we can see we have net income, right? This is profit and loss on the top. And then we have cash flow from operations on the bottom here. You have to reconcile it on the statement of cash flows. So it looks like they have a pretty significant jump in operating cash flow. And I looked on their 10Q, and this is very interesting, okay? Let's go look at this is their quarterly report, the most recent one. If we look at the financial statements and we go down to the statement of cash flows, increase in customer deposits. $1.1 billion of customer deposits. Okay. That's pretty crazy. That's pretty crazy. Okay. So basically what's happening here is they are getting a lot of cash from people paying money up front to go ahead and book. And as a matter of fact, if we go look at the balance sheet, let's see how much customer deposits is of okay, so a big part of their debts, and that actually makes total sense. A big part of their current debts is just customer deposits. That's money paid in advance. Okay, that makes their financial position look a little bit better. A lot better, as a matter of fact. That's why you have to check the 10Q sometimes too. Half of their current liabilities, $5 billion, is upfront payments people have paid in advance. Okay, so technically that's a debt of the company. But what happens is that becomes revenue. So if you look at this, they had a huge jump in customer deposits, which means people are booking tours. They're booking cruises. That's a good thing. Okay. So overall, the company is definitely doing a lot better. Okay. They had a terrible time, but they're coming back decently strong. Overall, my assessment is the only major issue is all the debt that they packed on. They're going to be paying way more interest. Way more interest. Okay. And a lot of the free cash flow is going to be going to paying off debt. So if you're looking for dividends or share buybacks, I mean, maybe, but if I was this company, I'd probably try to get out of this debt personally. So overall, like I can't make any predictions about the future, but I can definitely foresee this company not being as profitable until they get rid of this debt. Okay. And yeah, I don't know. Like, I'm not a big fan of cruises, like the cruise lines. Oh, I'm going to buy a cruise stock. It seems to me it was more of like a pandemic gamble than anything. And if you had timed it right, you would have made a lot of money. But now, I mean, like comparing the company's past to the future, I don't know, with so much more debt and so much more interest expense and high rates. If these high rates stay high for a while and they keep having to refinance their debt at higher interest rates, their profitability will probably not be as good as it was before. So, but overall, I've seen worse stocks in the world. Okay, I've definitely seen worse stocks in the world. So that's kind of my thoughts. Now, if you want your own personal video, you can pay me $40. I was paid to make this video. I got a couple more I got to make too. Do some comments. Here's the link. If you want me to make a personal video for you, you click that link and I'll make you a video. Made it easy, $120 already. Not bad. Meat Breath for sure going to find a way to copy this business model. I've done pretty good. Invest in Truck Stop for massive returns. Yeah. Lefebvre was pumping Carnival Cruise stock, which is around $60 in the crowd. Of course he did. Of course he did. He probably got 20 patrons from that. Lefebvre bought a ton of this stock. Of course he did. I bought Carnival Cruise Lines thanks to Paul G. Never invested in a cruise line again. I mean, the whole thing was it was a pandemic gamble, because like it was one of those things where are these companies actually going to die, or are they going to get bailed out and be able to survive, and then eventually go back to where they were? Did they survive? A lot of them did. Are they going to go back to where they were? Not with the debt loads that they have, because now they're paying way more interest. Like the equity of this company was annihilated. If it wasn't for issuing stock, their equity would have been wiped out. They would have had more debt than assets. So something to keep in mind. But when it comes to liquidity, it's actually not as bad as you'd think now that I actually looked at the 10Q, because a big part of their current debts are just customer deposits. And they had a massive increase in customer deposits. So that means people are booking cruises. Not bad. Paul made a video acting like he's better than Peter. Oh, yeah, I'm sure he is. Okay. So when are you going to reveal your 2023 YouTube? I mean, it's only been a couple months. I mean, I can show it. If you pay me $40, I'll do it. I mean, I've been doing okay. I'm not like making $20 billion. Hi, Weak Man. What's up? Lefebvre bought Carnival Cruise stock literally a month before the pandemic. Lefebvre. Let's see. I will give you blah blah if you review Fubo. Why don't you just give me $40? How about that? Strongman. I watched Jeremy Lefebvre. He makes flexing how good his portfolio is doing this year. He must manipulate. No, he just buys stocks at all-time highs. They crash, and then when they go up a little bit, he pretends like he made money. That's what he does. That's all he does. What about Palantir? I gotta wait till earnings. Thoughts on Tattooed Chef being delisted? I gotta see the earnings. I'm gonna wait to talk about it until it comes out. Stronger, would you really make a video on penile fractures? I'm going to send them money. Yeah, you send me $40 and I will. I don't care. Tattoo Chef is being delisted. I haven't heard anything. Strongman, private jet coming to an airport near you. Come fly to me, baby. Pick me up, Kevin. Take me on a flight, a tour of the United States. We can be lovers. Spoon in the back of the aircraft. All right, guys, that's it. Talk to you later. Cheers.